Hi, it's Farooq from Mubarak Ketbi Chartered Accountants. I'm a tax agent, corporate tax and VAT. In our last postcard, as we discussed, that we will now in our coming episode, we will discuss different topics that have relation with each other in the financial statements. Like sales have receivable. So today we choose a topic sales and receivable correlation. So Mr. Humayun is here. So hopefully he will guide us thoroughly. So welcome, Mr.
Thank
Humayun.
you, Farooq, for inviting me again to this series of webinar, and hopefully can contribute, as a learning or guidance to our viewers.
Yes, as we discussed, so today we'll discuss about the sales and receivable correlation. So we will pick first sales when the presentation, how to record it as per IFRS, and what are the things normally people are doing mistake while they are recording the transaction. So same way in the receivable also. So first of all, sales. When we have to record the sales, and can you guide what are the steps that we need to take care while recording the sales? And main thing, presentation.
Yes.
How it should be presented properly. Actually, no, I will just ask a couple of questions, then I will ask one by one. And what is the, while you are recording the sales, okay, how you will present in the or file a VAT return, what are the things, deferred revenue also will come, deferred revenue, and then while doing the being auditor also, what are the things, auditor check, what are the things that tax authority may ask. So all these things, can you just one by one, for example, let's start with when to record the sales, what are the conditions and what are the terms and conditions, what are the
Sure.
requirement that while when we have to record the sales.
Surely. Sales is governed by IFRS 15, revenue recognition. When you're providing goods or services to your customers, when they have been transferred or the service has been provided, or let's say legal title or ownership of the goods have been transferred to your customer, it's at that point that you recognize your sales. And sales are divided into two categories. You have your cash sales,
Yeah.
and your credit sales. So it's basically the credit sale will give rise to your other side of the balance sheet item, which is the receivables.
So as you mentioned, cash sales and credit sales also. In the cash sale, being auditor, when I'm doing the audit for my clients, if there is a cash sale, so as per auditor, I will keep eyes on the law, anti-money laundering law, AML law, because if cash sale, if some clients are doing too much cash sales, then we need to make sure that he's compliance with AML regulations. So that also point, I think that we also need to yeah, maybe consider while doing the audit. But uh, what if there is a cash sale, what tax authority want to see in the cash sale, how they, maybe someone is doing cash sale and not recording, and how tax authority keep eyes on the cash sales. E-invoicing also, know
Yeah.
they are planning to start. So can you just little bit
Yeah.
explain about the cash
So,
sale?
yeah, very good thing. Recently, this is the same thing which one of my, colleagues or friend also asked me about, that how can I ensure that, let's say, for example, small businesses, my salesman is properly accounting for the sales and a valid tax invoice is being issued to the customer. So here in layman's term, I would say that, how are you reconciling your inventory records with your sales? Obviously, you are converting your goods which you have, especially, or the services which you are providing, you're keep maintaining a log of that. So that's what the tax authorities will be looking at, your inventory log, how much of your inventory has come in, and how much of that, you must have applied a markup to your inventory purchase price and converted that into your sales. So they will be doing this sort of substantive testing with your records and bank
Excellent. Trust
statements.
me, being auditor, this is the things that auditor also keep eyes. For example, if someone is saying, I don't have sale, but when we check the portal, FTA portal. Client has imported the goods from maybe from China or from another countries. I told my client, I will say my client, the auditor who is doing the audit or the team leader who will ask the client, yes, guys, listen, you have an import, but no, you are seeing, but stock is not there in your warehouse. No, you are saying I don't have sale. So it means there is always a link
Yes.
when you start, when you end. So don't think that someone can play, okay, he will do cash sale.
Yeah.
So here, and as per AML law also, if someone is doing sales more than 55,000 dirham, they have to inform that this much money maybe they have received from the clients. But okay, small sales, maybe small items, 5 10,000, okay, yes, we can say, we can understand, but still you must have proper documents.
Agree.
So tax authority, if someone is doing playing like this, because they have the record, custom have the record, so is there any fines also, or they will just ignore it as a tax authority point of view?
No, see, it all depends upon the sensitivity and the materiality of the error or it can also be categorized as falsifying your records as well also. So it depends upon what the magnitude of the risk over here is, and accordingly tax authorities can impose a fine on the business.
Of
Yep.
course, of course, no doubt about that. If someone is doing playing with the financial data and not compliance with the UAE regulation, there must be, then law will take his own way, and authority will of course they will put the fines. Okay, cash sales, fine. I agree with you. Now let's move to the credit sales. So while doing a credit sales, what are the things need to take care?
Okay, here I'll explain you how tax authorities will be looking at it and what are the precautionary steps, or I would say the reconciliations which need to be kept as when you're doing your compliance either monthly or quarterly. So here now with the corporate income tax in UAE, and what I have seen from international tax as well also, is that how the tax authorities try to correlate credit sales is with your receivables, and then also with the sales amount which you have declared in your VAT return and the amount which you are declaring in your financial statements.
Okay, but you told, okay, sales with the receivables. So it means what reconciliation? How what type of reconciliation will be there? How tax authority will reconcile sales with the receivable? Can you just give with some example, because
Sure.
it will have better understanding for the viewers?
See, there are various points or timing, I would say, when a sale occurs. Sometimes it could be, let's say, for example, you're going to purchase a car and you have to make an upfront payment, which is called as a down payment. So over here, already if you see that, you have met the criteria for, issuing either a tax wise a payment or providing the goods, whichever is earlier. So here a taxable supply has already been made and you have received the payment. But the thing here is that should you be recognizing that as a revenue, or even though you have raised a tax invoice to the customer, you have charged him VAT, that's fine. But now from a financial statement perspective, the presentation is that an actually revenue? Because over here, if you see, your title deed is still not passed on to the customer. So apparently that is your deferred revenue, which will be shown as a liability in your balance sheet.
Exactly. So, but when we hear people think, if they have, in the sales as per VAT point of view, let's talk about the VAT point of view, because in this our all the topics what we'll choose in the coming podcast also. So we'll correlate audited VAT filing, corporate tax filing, maybe custom we need to check also. So we will correlate with each other. So where we need to concentrate more if we have some weak areas. Like in the sales, some people, in as a VAT point of view, the sale 0% also
Yeah.
there, 5% also there, out of scope also there. So as per IFRS, it's not mandatory we need to disclose 5% is this, 0% is this. But how authority normally catches the clients that if they are not disclosing properly, maybe they are disclosing properly,
Yeah.
but maybe they are misunderstanding the type, is it 0% or 5%, or mainly what documents they have to keep also,
Sure.
because of course the authority will come, he will ask for a document.
Yeah. So here, I would say presentation plays a key role over here. Now, the thing over here is that you need to break up your sales by having as much as information as possible, by customer wise, by invoice wise, by voucher number wise as well. Also, because the thing is that you need to prove to the authorities that in substance a transaction has occurred, whether it is a standard rated sales, zero rated sales, or an exempt sales. Accordingly, you can, so if you work backwards, you're basically breaking up your total sales into your these three components, and then substantiating it with your safeguard, which is your tax invoice. So obviously, if you have made a standard rated sales, you will have issued a tax invoice to your business or to the customer. And then even if it's like an export of let's say to some other rest of the world, then you need to ensure that you have your exit certificate, or earlier, before the recent clarification which came out from FTA, earlier there was a very lengthy process which you have to go through to explain that this is my exports sale, by having your airway bill, your
Exit
your
certificate.
exit certificates, your export documents. But now the FTA has clarified that any one of these, whichever is you have readily available, is good enough to substantiate that it is an export sale.
Okay, if 0%, as you mentioned already, exit certificate or a declaration or all this, that's if FT told, agreed. 5%, okay, if you are doing business locally inside the UAE, so it means simple documentation is required, maybe only delivery of goods and
Yeah.
services. But when it comes to the out of scope sale,
Yeah.
so here, I think difficulty will come. Yes, not for VAT point of view. Okay, if you are buying from China and selling it to Africa in any country,
Yeah.
out of scope sale is come. For VAT point of view, okay, yes, I don't see any much trouble for VAT point of view. But when it comes to the corporate tax, see, no sales is there,
Yeah.
because if sale is there, end of the day bottom line, profitability will come, so you have to pay taxes. So in this case, what documents being a tax authority, if you see, for example, what document for the out of scope sale, what document as a tax authority will they have to rely on this?
Sure. It's not just Farooq, out of scope sales which we have to substantiate to the authorities. As I said earlier, you have to have your breakdown between your let's say you could have you know transactions with your mainland and your free zone as well also.
Hmm.
So you need to have a breakdown, okay, that which are my sales which are being made to the mainland, which would be subject to corporate income CIT of 9%. Free zone will not be subject to CIT. So the thing over here is that tax authorities, what they are trying to do is, in layman's term, they are trying to link your sales amount in the VAT return with your sales amount in your financial statements and CIT return, and then your receivables over here. So as much as detail you have possible, you can give them. Yes, there will be some challenges, like there could be some timing differences, because you could be accounting in your financials or CIT return when you're declaring your sales, you could be following accrual based
Hmm.
accounting as well. Like for example, you could have some accrued sales which you have booked, but that has actually not materialized yet.
Mm.
So these are the some of the timing differences. There are some more challenges as well also.
Well said. As per tax authority point of view, might be they will look for this because of the experience. But as an auditor, when we are doing the audit, so what we mainly see, okay, if out of scope sale is there, we ask the client, okay, give us the shipping documents also, because if it's buying from China or any other country and selling to other, so shipping documents play a very
Yeah,
important role. So in all these shipping documents, the main role what we mainly concentrate on certificate of origin,
yeah,
because from there we came to know these goods are being exported from China or any other country. So, but big challenge for the auditor, because the transaction happened a year ago. They can't. They have to just rely on the document. Sometimes authenticity of the document also a big challenge,
agree.
and this is old transaction, because if it is right now happening, okay, they can trace also through the shipment. But old transaction, big challenge for the auditor.
Yes,
But of course, there are some guidelines, standard, and auditor, if satisfaction is there, then it's fine.
agree.
Okay, for the sales point of view, I think mainly you covered already the VAT point of view. No sales, if these sales are being recorded, same time, receivable also,
Yeah,
if it is credit sale. So receivables, how to reconcile sale with receivables, and while you are recording the receivable, a big challenge also comes. People, they are selling, but sometimes they are not getting the payment.
yeah,
Bad debts are there.
yeah.
So bad debts relation with the receivable, how to present this, and earlier, maybe no also, people might be they will book higher bad debts
Agreed.
just to reduce the profit.
Yes.
So how, what are the guideline here
Yeah.
as per tax point of view?
No, good point. I would say good question which you have raised, Farooq. Especially with currently, no clarification on, how provisions are going to be treated. Because in other jurisdictions or countries, if you see normally, provisions which are under IS 37, provisions of contingent liabilities, are treated as estimates, and normally the tax authority do not allow deduction for this if you are creating provisions. It's only when actually these provisions realize into cash basis, at that time you can take a deduction for that. But this is a very I would say something which businesses can explore, how you have said. But again, there should be some basis as to when you are creating things like provision for bad debts related to your receivables, especially general provisions. There should be some basis. Specific provisions, yes, you can trace them back to your customers for which these have been created, and these will be substantiated by your aging as well. But a very good point which you have raised is, normally when business give information to tax authorities for receivables, they forget to break it down into three components. One of the components which is provision for bad debts, because sometimes what happens is that tax authorities, looking at your financial statements, they might want to test you that how are you going to present or correlate your receivables with your sales. So here there are three components which you need to give the tax authority breakdown of your actual sales which have resulted in your receivables, credit sales. And then you will also be receiving payments for receivables as well also.
Yeah,
So
during the year,
yeah,
whatever payments received.
yeah, cash would be coming in. And then your third component is your provision for doubtful debt. So the more clarity you can give for these three components, the more you can correlate your sales during the year with your receivables.
So it means no onward being auditor. So we need to give the disclosure with more detail.
Yes,
So so it will help the authorities also, tax authority also.
yes,
They will know, okay, this is the receivable, this is the bad debts provisions, and this is the basis.
Yes.
So if these disclosure already mentioned, so tax authority don't need to dig, and they can just simply estimate and understand,
Agree.
okay, things are, it means fine.
Yes. See here, that's why the way the UE law has been drafted, it's more focusing on your IFRS component. So basically, the more clarity you can give in your disclosure notes by bifurcating your receivables between current, non-current, your provision for bad debts, the more you can avoid from FTA
Audits.
raising, yes, during your inquiries or audits. So it's like, as I said earlier, also the return which you are filing, CIT return or VAT return, it's on self-assessment basis. So here, the more you challenge yourself, the more you challenge your financial data, the better answers you can get and prep yourself for future audits or assessments.
Okay, but here, let's I will go back to again to the sales. In the sales, sometimes presentation is not properly done. Like if sales return are there,
Yeah,
okay, while you are doing, while doing, can you just sales? What are the item will come in the sales with breakup, and what happened while you are doing the VAT return,
yeah.
and what will happen while doing preparing the financial statements. So just explain a little bit more
Surely.
about.
See, basically, what happens over here is that, let's say during your tax period, you will be getting some rebates, some returns for which you will be either issuing a credit notes or you will be, issuing discounts. So if you see, all of these items are correlated to your sales. If the sale had not happened, you would not have been able to give your discounts, you will not be able to give a rebate, or you will not be able, if there are any returns against that sales, you will not be able to issue a credit note. So here, the major issue which I have seen is that the way these items, credit items are, or credit notes or rebates, I would say, are treated in the financial statements. Erroneously, they are shown in the financial statement as part of your cost of sales. So now here, what happens is that when you correlate, this item with your sales which you have declared in your VAT return, obviously that would be much higher as compared to, sorry, it will be much lower
Lower.
as compared to what you are declaring in your return, in your financial statements. So the tax authority can say that you have underpaid, your VAT to that much extent, and they can even penalize you as well.
So it means you mean, for example, if sales happened, uh, no, if sales happened, there is a sales return. Of course, when sales return is there, so as per VAT return, so it will reduce and it will come in the adjustment column also.
Yes.
If so, so sales will be less. But while doing preparing the financial statement, might be this chart of account, this code, sales return, you put, some
Separate
people
chart of
put
account.
in
Yeah.
the separately, maybe in the cost of sale,
Yeah.
wrongly. So this way in the financial statement, sale is more. In fact, it should be net off after sales return.
Discount. Yeah.
But in the VAT, of course, you adjusted the VAT also. Then sales is less there. So here, authority will might ask,
Yeah.
because they have the data, so they can ask.
Yeah.
So it is very important. You have a proper disclosure.
Yeah.
You have a proper presentation,
Yeah.
and you must have a proper record, and must have an expert tax consultant or auditor, whoever your consultant is, tax consultant is,
Yeah.
ask proper guideline. So he is the one who can guide you related to IFRS, related to tax return. So I'll go back to again now the receivable side. In the receivable side, normally the tax authority, if up to what extent, because the receivable, as per IFR, they have to follow ECL, expected credit loss. Also, you need to calculate accordingly. You will put the bad debts provision. So, what will happen if one of my client, he is doing business last 10, 20 years. No, already provisions are there in the books of account. Maybe provision, maybe 1 million provision
Yeah.
already. Opening balance is coming. So now 2024 already started. what will happen next year? He thought, oh, okay, he did over provision, no, he want to reverse. So what will happen? Do he has to pay? No, the because no provision will reverse,
Yep.
it means it will go to no other income. If it is go to other income, it means corporate tax will come.
Yep.
So what do you suggest here?
See, here, there is a bit of tax planning that can be done as per, your transitional rules. And the FTA has given clear guidance that your closing balances for 2023 will form your opening balances for 2024. So, like what I what businesses should have done over here, there's an opportunity to avoid yourself being impacted with huge corporate tax in 2024 if a write-off is being done for those opening provisions now in 2024. Obviously you will have to pay 9% CIT on that, but had you written off all these provisions which did not require in 2020 before the end of 2023 or 31st December, by 31st December 2023, you could have avoided paying the 9%.
So it means I think the highlighted point for today overall discussion, like sales, okay, you explain how to present.
Yes.
Already explain credit sale, rebate is there, how it relate with the VAT, how it relate with the corporate tax, how tax authority will look, because they have VAT data also, and even they have a bank statement. Of course, government have access to tax authority have access to everything. So as you already mentioned, and when it's come to receivable, you mention, okay, we must have general provision, specific provision, okay, yeah, how to calculate ECL, follow IFRS. Here, the whole discussion, it means ends up here. If we have a provisions and it is lying as a opening closing balance in 2023, correct me if I'm wrong, please. If the opening balance of 2024, if you have a provisions, so that provision, if you will reverse in 2024 or 5 or later on, so whatever provision, excess provision you booked, so it becomes your other income.
Yeah.
So it means you have to pay taxes.
Yes. Rightly said,
So
Farooq. See, what I would suggest over here is that the tax authorities can challenge you from every aspect. As a next step, businesses should make themselves ready with respect to involving your consultants, training your staff, and keeping all sort of reconciliations from your sales to receivables, from your sales to cash inwards on your bank statements, all this in handy and ready, because CIT is here. And if anything gets opened, let's say during your CIT audit or a VA, or it will have an impact on your VAT and vice versa. So businesses need to get ready with
So it means it's very important. You must have a proper auditor.
Yeah.
You must have a proper tax consultant who knows all these things. Otherwise, you think nothing will happen, because in the market people are saying that if you call someone, sir, do I need to pay corporate tax on 2023? He will simply say, no, 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 you don't need to pay corporate tax. Of course, yes, on 2023 profits, you will not pay tax. But these, these are some points, but you have to take care while doing 2024 accounting and tax. So better if you go 2023, if someone have not done the audit properly, do it properly 2020, because opening balance will consider from closing balance of 2023. So it can have a huge impact, as Mr. Mayu said. If you have a lot of provisions and now you are going to reverse it, it of course it will be other income. Then you have to pay tax.
Agree.
So today's, I think let's finish this instead of moving to another financial statement item. We can maybe have next podcast like this.
Surely.
So it means today sales receivable correlation, very important. Your opening balances, especially related to provisions. Thank you so much.
Thank you, Farooq, for your time as
Coming
well.
again, taking
Pleasure.
your
Pleasure is all
time.
mine.
Thank you so much. Hopefully see you soon again.
Surely.
Okay,
Thank you,
thank you,
viewers.
viewers. Take care. Bye.